If you're managing a fund right now, there is a quiet crisis building inside your investor base, and most managers will not see it until it's too late to fix it. A former PayPal and eBay CFO who has structured over $1 billion in financing just revealed the exact system for buying into the world's best deals for VC funds at up to 70% below market value, and how to give your own investors a liquidity exit before they start demanding one. The managers who understand venture secondaries right now will have an unfair structural advantage over every fund that does not. This is that conversation. All this and more coming right now. Here we go. Aman, welcome to the show, man.
Thanks for having me, Ryan. Great to be here.
Yeah, it's great to have you. I have been so impressed with your background as CFO of eBay, and you worked as part of the PayPal mafia, as it's so the affinity term. It's really good to get in here, and we're going to talk about venture and secondaries and really everything that you've been able to do, man. So I'm excited to talk about this. So let's dive in, brother. You went from writing the first draft of PayPal's S1 to CFO at eBay and Sonos, and to COO at 500 startups, overseeing 500 million AUM investment committee, to founding now Practical VC. Every step of that career was a deliberate acquisition in skill. So for the fund managers who are listening and trying to build their own credibility and track record right now, what would be some of those specific sequence of moves that you would tell them to start accelerating their process starting today?
Well, you make it sound very linear and very logical. In reality, it wasn't quite that. I'll tell you a bit about the journey and how it went from one to the next, and what lessons that might have. I don't really know if there's a single way to get to where you want to go to. It's being a venture manager is a role that's not really path dependent. I think it's just an accumulation of skills along the way. And when you're at the point where you can manage money, you should be able to do a few things like evaluate investments. It's going to entail a bunch of fundraising skills and talking to investors. And there's a whole administrative side of the business too that is really important in managing money. My background was I began on Wall Street. I think if you'd asked me when I was 16 years old, I grew up in Toronto, what do you want to be? I would have said I want to be an investment banker. I want to work on Wall Street. I want to work in New York. Why do you want to do that, Aman? Well, I loved Michael Milken. I was enthralled with the American finance. I was good at math. I was good at economics. Michael Milken was one of my heroes growing up. And so you kind of follow what you want and follow your passion. And that's where my passion led me through Stanford undergrad, studied economics, ended up on Wall Street. And then from there, I think if you'd asked me when I was 24, what do you want to do? I would have said, I probably want to stay an investment banker. But the rules of most of the Wall Street firms at the time was like, go and get a graduate degree. So I did from Harvard Law School, came back thinking I wanted to be an investment banker. And Peter Thiel talked me out of it. I'd met Peter undergrad at Stanford, happened to meet him. He happened to start a company called PayPal while I was in law school. And he talked me into leaving that track into operational finance. I learned a ton in operational finance. I learned a ton on Wall Street. I think if I'd advised my daughter getting into, she's now 15, but in 7 years, she'll be graduating from college. And she says, hey, what should I do? I'd be like, well, if you want to be in venture, running a company has a lot of, difficulty and complexity. If you want to be learning from the best, I think starting at a company where you're going to be around the best and learn from the best has a lot of value. In finance, you get a ton of training in investment banks and in bigger companies that are going through audits that do it well. In startups, there are a lot of bad habits and loose behaviors that kind of get communicated throughout the team. Bigger public companies will teach you a lot of things that you need to do to manage a business and interact with people. And I think those are all good skills. And then for me, getting out of the operations and learning a lot about then was a good transition into venture. I think if you try to get into venture right away and making investments and managing money, you've never run a business before. You've never been dealing with boards or haven't had to go through all the things business managers have to do. Pivots, layoffs, M&A, fundraising. Like to do that as a first-time founder is hard. Not everyone's going to be Mark Zuckerberg, and even if you are, you have to have a Sean Parker or a Peter Thiel, I guess, around to help you through it. So I would just say, learn from the best, be around the best, take jobs where you can learn the skills that are the building blocks to what you want to do, and think about for your next role, what's your passion and where you're going to learn from the best.
That's absolutely brilliant. I've heard it said that you spend the first half of your career building your resume and the second half building your legacy. And so it sounds very much so for you. Yeah, same with me. I remember that. And I remember catching heck for my own mother was like, why are you doing this for free? Why are you helping all these rich guys for free? Like, she didn't understand it. Well-placed to mother, and she wants her son to whatever. And I graduated in the height of the recession. So not a lot of investment banking jobs. And I said, I'm working on something here. And I remember it was a phrase from, in college, I read Rich Dad, Poor Dad, right? So a lot of people have read that book from Robert Kiyosaki. He said, the rich don't work for money. I said, cool. I have aspirations to be well off. But not from just the money, but from the ability to add value. So I said, okay, what does that mean? They don't work for money. I mean, how do you pay bills? And that put me down a track where I was like, they don't sell their time, they sell their value. And so I was like, okay, I need to create value. And that's what you were able to do when you were working with Peter Thiel and Musk and all those guys, is you were working at these companies where it allowed you to create yourself, your resume, so that it's pretty obvious that it's like, well, I can have higher roles. That's fine. But I think what it showed is I'm able to add more value. And I think that's what the heart of what you would advise your daughter is to say, you can go to these companies, you're going to learn some really good things. And those learnings you're going to take out into the world and add value, especially if you're running a venture fund. When you got founders and portcos, you got to add value to these people because your own reputation's on the line. So you did a good job. So I think that's what I'm hearing is just make sure if you're just starting out, make sure that whatever skills you're doing, make sure that you're always allowing yourself to have the space to gain the skills that you can add value and then, allow your career to go from there. Would you say that's an accurate assessment?
Yeah, I think that's right. And if you are in a big company and around great people, it's easy to get good habits and become valuable or acquire the skills that will make you valuable. If you join a startup or you start a company, you can still get there. But then I think what you have to do is figure out, all right, if it's 3 people in an idea in a garage and we're all 23, I'm not going to learn from my 23-year-old bestie in college how to be a world-class, whatever it is that you want to be. Let's take the case of a fund manager. You've got to be a world-class investor. You're not going to learn being around 23-year-olds how to become a world-class investor. But you can recruit a top investor on your board. You can raise money from folks like, Mark Andreessen or E16Z partners, or find the VCs that you want to be like, and then have them in your network, have them on your board, just work with them, and you can create other networks. I think that's a lot easier now than it was 25 years ago because the world is so connected. So if you take advantage of those networks, I think you can still get there. But that, I think, that's the homework, right? If you join a small company or a startup that doesn't know, let's take the finance example. As a startup, you're not doing audits. You're dealing with kind of loosey-goosey revenue accounting. It's not going to be GAAP or accrual. It's maybe cash accounting, at least until you're Series A. So you better have people around you who can educate you about what it means to be a world-class finance person. Whether it's a good finance lead, an auditor, an accountant, somebody who's advising you along the way and helping you with the fundraising and build the company the right way. That's the missing skill set that you have to build. You kind of get that when you're in a big company, right? You're in a Meta or a Alphabet. You're surrounded by great accountants, great leaders, great IR people, great fundraisers, great product people. So they're in the hallways. It becomes easier to do that, I think. Which is the advantage of a big company, but then there's disadvantages too. But that's how I think about it exactly.
Brilliant. You've identified a liquidity crisis in venture capital way before most people were even talking about it. So my question, you can talk about how does a fund manager audit their own fund structure today to know if they are already building that problem for their LPs?
Yeah, I can give you some just basic math around what these portfolios look like. If you're a Series C or Series A investor today, on average, these funds, and this is just from investing in startups through Founded Startups or Founded Global and being around venture now for past the decade or so, to get to a 1x of DPI, it takes 10 to 12 years for a typical fund starting out today. So you have to plan ahead on what am I going to do in terms of DPI over the next 10 to 12 years. First of all, can I and my LPs hold out that long to get 0.5x or 0.7x or 1x DPI if I'm a median or above median fund? If God forbid I'm below median, at least in distributions, I'm not even there. So how do I, first of all, message and set expectations for my LPs? The next thing you can do is to create those liquidity dynamics. You could figure out from your portfolio, what am I going to do to make sure this portfolio, either I know the companies in the portfolio that are planning on going public or that are potential, M&A candidates. If I can list those companies and be realistic about an exit timeline, I can begin to forecast and think through liquidity. If IPOs are not there, if M&A is not there, the third stool is secondary markets. So having your portfolio, I think, prepared for secondary evaluators is just a good thing. You don't need to do that in year 1 or 2, I don't think, but year 5 to year 7, your LPs will get squirrely. That's what we found. And the fund can be doing well, and the companies can be doing well, but the LPs need liquidity, and they maybe didn't sign up for this 10 to 12 or 15-year journey. So you want to be talking to secondary investors, I think, by year 4 or 5. You want to know who they are. You want to be communicating with them. You want to be able to educate them about the portfolio. You have to have information about the companies in your portfolio. Just have the quarterly updates, have the financials, have the relationship with the founder where a secondary investor can come in and kick the tires and do the research and do the homework and get educated about the portfolio. All that takes time. So I think just prepping the portfolio, identifying the buyers, and then giving them the information that they need and building that relationship with them will give you those avenues for liquidity in years 5 to 10 when some of your LPs will need it. And that's just a good, it's just a good planning mechanism, I think, to give your portfolio some air.
Oh, I love that. You know, I always say the three most valuable assets in your possession as a fund manager is your reputation, your relationships, and your results. And you talked about the second R, which is relationships. And I just wanted to underscore that the importance of what you're saying is when you started out. So you said, okay, DPI, that's a liquidity thing. Are we returning money to our investors? And under that, how do we do that? So like you said, could be, you didn't say these words, but it could be a 10-year lockup, 10-year trap. And these investors, some of them go in and they're like, yeah, it's fine, 10 years, whatever. But some of them, life happens. And maybe they were fine, but they're not now. Whatever the reason is, doesn't matter. You need liquidity before you thought you needed liquidity. So we're in a little bit of a situation. And so I love what you talked about. And I just want to underscore this for people who are listening, for the emerging fund managers, is to say, is what you're saying is actually have those relationships of secondary buyers early on. Build those relationships. Just it's better to have them, not need them, than to need them and not have them. So build those relationships, and then you go through it and say, you know what, we might need to roll off and have some liquidity and roll off some of our position. Okay, well, we've prepared for that. We have the relationships for that, and we can start setting that up, man. I absolutely love that. Anything else you can add to that, or did we pretty much nail it?
I think that's perfect.
Awesome, man. Well, I'd love to talk about using venture secondaries as a solution here. So once a manager recognizes that problem that you were talking about, what are the specific steps that they take either to access the secondary market as a buyer or just restructure their fund to attract one? What would you suggest?
Well, I think if you're a manager and you've recognized now that you need to have you want to explore the secondary option really on behalf of your investors, right? Some GPs need money. Let's start with the premise that your LPs are the ones who are pushing for having secondary options. I think what you want to do is you want to give them a couple of things. You want to probably be engaging with 2 or 3 secondary buyers, and you want to give them time to evaluate the portfolio. So you don't want to be going to a secondary market where your LP needs money, right now, or they have a loan to pay back or a house to buy, or they got a tax bill to pay by like April 15th and they come to you on April 1 and they tell you, hey, I need to liquidate my portfolio. What can you do for me? That's not a great situation to be in, because you're going to be negotiating with a single buyer in a short time frame. You need the money and they can take time. And so you're not putting yourself in a good position. So I would start the conversations with the secondary buyers before you think you need them. Identify the top 2 or 3 you think in the space. So there'll be a bit of a bidding competition for your assets. You can talk to us. There's Industry Ventures. There's Sendana. There's 137 Ventures. There's 3 Spoke, maybe Klein Hill. Depends on the category. Depends on the sector. So get educated about who those people are and start those conversations early. I would just try to spend time with them, even before you have this conversation with them. Educate them about the companies that you've got in your portfolio. Hey, this portfolio's got 50 companies. These are the 10 or 15 that really matter. Here's the information I have. Do you want to meet the founder? Do you want to talk to the team? Come to my LP meeting next quarter. We're going to be deep diving on one category, maybe highlighting a couple of our companies. We'll provide you their audited financials when we get them. That might be, a couple of weeks. So prepare the data room and start to give these guys a sense of what the portfolio looks like long before you think you need them. They'll be educated. They'll be informed. If you got 2 or 3 educated, informed buyers, they'll probably give you the best price for the asset. So that's, I think, and that makes, as a secondary buyer, that makes my job easy. If a fund manager hands over, here's the financials, they've been audited or they haven't, here's all the companies, here's where we're holding them, here's our accounting policy. You pick the 10 that you really want to deep dive on. Maybe I, the buyer, maybe I know 7 of them already from my own research. I don't know about these other 3 companies. I'm going to do some, as a secondary buyer, I'm going to do a sum of parts and figure out what the portfolio is worth. So help me fill in those gaps and help me do the research that I want to do and give me the information, help me deep dive and have that data room ready. I'll be a much more effective secondary buyer, and you'll end up with a much better price at the end of the day.
Brilliant. So it almost comes right back to, I think you've gone deeper, is back to those relationships, but also under the subtext of saying, but know who the real players are in that industry, just in case you don't have a relationship. Better if you do. Just in case you don't, you got to know who are the big buyers. If you got to move a lot of product, and I know I sound like a drug dealer right there, but if you got to move a lot of shares, please don't do drugs. Yeah. It's got to move it fast. Yeah. So if you got to move it, you got to know who's going to buy it, of course. And now I got to be very careful of what I said. So we set that frame. But in all seriousness, Aman, when everything underneath a secondary position is private and disclosure is limited, talk about the exact process you use to evaluate whether to pull the trigger or not.
So when we're buying a fund position, what we would look at it as just a portfolio of companies. So I'm going to go through all the companies. And usually what I'm going to do is I'm going to start with, are you familiar with the power law dynamics in venture? Mm-hmm. Yeah, hopefully your listeners are. That's not as common a theme in private equity, but it's kind of a well-known venture aphorism that most of the value is going to come from a very small number of companies. Usually out of a portfolio of even 100 companies, maybe 5 of them will really determine the total value of the portfolio. The other, the other companies are going to be write-offs or close to zero, or it's kind of gravy for us. So we'll want to diligence probably the top 5% of the portfolio. And what we'll do is we'll go through, first of all, give me the financials of your fund and are they audited or not? And let me talk with the auditor. Let me go through those top 5 companies and see where you're holding them. How many shares do you have? Do you have common? Do you have preferred? Where is that in the capital stack? What's the price per share you're holding it at, and why? Is it the last price round? Is it, where the secondary market is setting the valuation? If it is the last price round, which is typical, well, who set that last price round? Is this benchmark or founders fund last month? Or was is the price you're holding it at set by some family office in Thailand in 2021 when money was flown through the hallways? Or was it set by Tiger or SoftBank, in at the height of like the COVID bubble? And so based on that, we have basically our own heuristics on which funds we trust, who did the homework, are they on the board, are they not on the board? Really what we're getting to is the valuation reasonable or not? Does it deserve a 20% discount, no discount, or a 70% discount based on the price setting and based on the lead investor? And then we'll try to re-underwrite the top companies and try to get the financials. So if you have them, top line growth, revenue, cost of goods, unit economics, try to get down to EBITDA, net income, sure. I'll try to get to a free cash flow number. We'll base it, on that. And for big companies that are closer to an IPO, maybe we'll use comps that are in the public markets. For a company like Databricks, we'd use Snowflake. For a lot of late stage private companies that are maybe not that close to an IPO, but we kind of know what Series C e-commerce and SaaS companies should trade at, just given growth rates and unit economics and, valuations in the space. Some of the stuff, we kind of have to figure out, hey, what do we pay for this rather unique asset? One of the big companies in our portfolio is SpaceX. Neither I nor my partner really knew how to value SpaceX before we got into it, but we got in at $73 billion valuation. My partner, Dave McClure, he complained about the revenue multiple at $73 billion valuation. He still complains at 1.25 trillion that, the revenue multiple is too high. But there it is. It's a 20x win in our portfolio, and we're still complaining all the way up. So some of this stuff you just have to. So what do we know about SpaceX? We then do the research on the team, the technology, the defensibility, the market size. So we go through this exercise for all those companies in the portfolio that really matter, and pull that from the fund manager, from the seller. We pull it from our own network, our own resources, and try to cobble together the business strategy for it.
That's brilliant, man. So you've bought positions. I didn't know you were in SpaceX. That's incredible. And among many others, I'm assuming, working directly with Elon at PayPal, it certainly didn't hurt. And your partner, Dave, is just as impressive as you are. So I'm not surprised you guys get these elite tiers. So, you've bought positions at discounts from 20 to 70% below NAV. That's amazing. What is the step-by-step method that a manager should use to price an asset that really has no market? It's tough.
Well, if there's no market, you've got a couple of choices. You could take if it is a company like a late stage Series D company that is either in a category or just at a growth rate or at a scale that is just hard to find in the public market. So we can take OpenAI and Anthropic as examples. Like how do you price those things? One way to do it is you kind of work backwards from what do you think an IPO is going to be and why? So what are the multiples that the public market would apply to a late stage company like that? Anthropic is an example of something like $30 billion in ARR right now. If you're an accountant, you already know that ARR isn't a real thing. You have to turn that into revenue and GAAP revenue and what's been recognized. And so let's assume you have to kind of go through all that process to figure out what the top line looks like. They're adding about 8 to 10 billion in ARR every month. So if they keep doing that till the end of the year, they could be at 80 to 100 billion at the end of the year. You can see how based on public company comps, a company at 100 billion in ARR closing in on it might be like 8 to 10 times revenue. Just based on SaaS indexes and stuff like that. So that could be $1 trillion IPO, and you got to figure, well, if it's $1 trillion IPO with some risk and time value, at the end of the year, what do I want to pay for it now? We also could just benchmark OpenAI to Anthropic. Which one would you rather have? They're both around 30 billion in ARR. One's got a big lead in the consumer space, OpenAI. One's got a really big lead in enterprise, Anthropic and Claude. Which one's growing faster? How do we compare the rev rec of the two different companies? Both of them are raising a ton of money. I think OpenAI is burning a lot more money. My partner and I, by the way, we do this breakdown all the time to compare, which one do we think is the winner? And we have a weekly podcast that we do where we recently did the OpenAI versus Anthropic bet. And that was at a time when OpenAI had a higher valuation than Anthropic, but we actually convinced ourselves literally on the pod, it should be the other way around. And you might ask why? Was it financials? And I think it's part of its financials, part of its growth rate. Part of it was the team. OpenAI has had a lot of churn over the past 2 years. They've had just key roles of folks dropping out. Their founder and chief scientist, Elias Sutskever's dropped. They had a couple of board members who left. They've got their COO, their CMO out on leave, their Fiji CMO, who actually used to work for me at eBay. She's at OpenAI, and she's the CEO of their applications business, their advertising business, where most of the revenue is going to come from. She's had a health problem and she's out on leave. So I'm looking at all these things. I'm like, how do you go public? Honestly, if you've got like literally half your management team on leave, or 6 months in, or you've just rotated people in and out of roles, you've lost your CTO, CMO, head of applications, you've lost a couple of board members, you've lost 2 founders, all of this, and Sam himself has come and gone, right? So you've actually lost your CTO and brought him back. I've been on these IPO roadshows. There's no way this team, until they can form and build a cohesive unit, there's just no way they're going to be an IPO ready company in the next 3 months. So we ended up talking to ourselves for all these reasons. We go into team strategy, financials, comps. Eventually we get to maybe a model where we do a discounted cash flow analysis, just a salary check evaluation. And then we say, do we think this is reasonable given everything we know? If there's usually you can find comps within Series C and Series D companies, Series, seed and Series A, find buckets of companies that sort of comp to it as well within similar categories, and try to, as best you can, to triangulate an evaluation. But it is a lot of judgment at the end of the day.
Man. So I love this. What's the name of the pod?
It's Trading Places VC, Trading Places Podcast.
All right, man. Yeah.
YouTube and Spotify, and you'll see the shorts on Facebook, LinkedIn, and TikTok.
All right, man. Well, I'm a fan of you, so I'm already a fan of the show. I'm excited to dive in, brother. So, this is an interesting. This one actually one of the things that is equally impressive about alternatives, but also very frustrating about alternatives, is sourcing deals. Right? Like you don't have this open liquid market like public, and there's really no listing service that I've ever heard of, at least at scale, that would compete with public markets. So, give our listeners the sourcing playbook. Who do they call? What relationships do they need? And how do they get to the other side of that secondary trade?
Well, if you're after companies, you can probably find there is no one listing place. You're right. There are exchanges or brokers who make, through third-party transactions, they'll make companies available. There's Equities End, there's Forge, Hive. There's a few other places like that where you can find companies. The way we don't really do that, we have a broad network of investors and LPs and people we've been working with for many years who are essentially giving us looks at companies. And for funds, secondary funds, there's no exchange. So that's just a lot of legwork. It's just a lot of meeting people, knowing who to talk to, talking to LPs, talking to investors. The thing that we've done, I think that's served us really well, is we have good relationships with GPs here in the Valley. So and that's because we've been in the Valley for 20 years, co-investing with Excel and Founders Fund and Andreessen and Benchmark and all the top funds through our 500 global network. So when those funds think, I need a secondary buyer, one of my 100 LPs wants out because they have a situation, family office stuff happens, tax bills, people die in families, you have estate planning issues, corporate VCs change strategy every couple of years. They'll refer those people to us. So the reason we got into SpaceX is, we got there through Founders Fund, for instance. So we figure out how to source from that network of colleagues to get us into deals that not everyone will see.
Brilliant.
Hey, if you're finding value out of this discussion, could you do me a huge favor? Could you just take a second and hit that like or subscribe button? It costs you nothing, but it tells the algorithm that this is valuable information, and it helps us to get it to more people. Thank you. You're incredible. Now let's get back to the show.
The first time that you and I met, you told me a story of the 3 blind men and you related it to trying to figure out when there's no solid market. Maybe you can walk that metaphor through of trying to say, you ask 3 people, you get 3 different pieces or 3 different takes on a company. Walk us through a little bit of what that's like using that fable of the 3 blind men.
Yeah, this really gets to diligencing the company. If you can use your sources to find companies, it's still very much a game of asymmetric information where nothing is public and nobody will tell you the full story about the companies that you may want. And so the question is, well, how do you get the information then that gives you comfort that you're seeing the whole picture and are making a good investment? And the thought that comes to mind is it's an old fable. I think it's an Aesop's fable, or it might be just an old Indian parable about a group of blind men, and 3 blind men encounter an elephant for the first time. So they have no concept of what the animal looks like. And these 3 blind men decide to see the elephant by touch. So each man feels the elephant, but elephants are big. So you get 3 of them are essentially touching different parts of the elephant. The first man touches the leg and concludes, the elephant is like a pillar or a tree. And the second guy says he's handling like the tail. Second guy says, no, the elephant's not like a tree. It's like a rope. And the third guy is over by the tusk, and he's like grabbing hold of the tusk, and he's like, "What are you talking about? The elephant is like a spear. you guys are smoking something." And so the three of them now have to collaborate. Wait a second. I no one of us saw the entire picture, right? So you can go to PitchBook, you can go to Precon, you can go and get information from Carta Insights, you can get from CB Insights, and you'll get press releases, and you'll get little snapshots. You're like a blind man running around feeling up the elephant and trying to figure out, what does this thing really look like? Do I have a full picture of everything that I need? And the answer, inevitably, if you only rely on one source or one set of conversations, is you'll probably think the elephant is like a spear. And then the next day you'll realize, wait a second, there's like a rope, element to this thing. And then the third day you'll realize, now I haven't talked to another source. Maybe it is a tree. And so you just have to be an investigative journalist, man. You got to go hunt down all these different sources and talk to investors, former employees, customers, talk to the company, but companies won't always share information with you. If you're buying from a fund manager, ask the fund manager what they have, and you got to pull together, through all these different clues. What is it that you're really buying? And then where's the price you're going to pay? So that's my best advice, is just be a sleuth about this stuff.
Yeah, so it's almost like putting each puzzle piece together, and adding that, and customers and former investors and insider management information, and really trying to understand the pieces of the elephant before you can actually see it. You got to get different components, man. I absolutely love that. Now, you worked alongside people who went on to build some of the most valuable companies in history. You got one hell of a resume, brother. What are the specific behaviors you observed in the best of them that perhaps some fund managers can use right now to evaluate whether a GP or a founder is even worth backing?
There are a couple of traits so on that early PayPal team, as I said, I had the opportunity, just a fortune to work for. It was Peter Thiel and Elon Musk, who were the CEOs of the company. And on the board, we had Steve Chen, who went on to found YouTube, and we had Jeremy Stoppelman, who founded Yelp, and we had Roelof Botha, who until recently was at Sequoia, and we had Reid Hoffman, and Keith Rabois is, he's CEO of Square, and he's done all kinds of amazing things since, and is a venture investor. So very early on, I think my read of it was, first of all, the best of them, the best founders that I've met, and even in the days since those early PayPal, this has been reinforced. I think just being super smart is like table stakes. How do you know when someone is extremely smart? I mean, they're very capable, they're very thoughtful, they're inquisitive. One of my tests is if someone is talking and I find myself taking notes or wanting to hear what that person has to say about a certain topic that they clearly know, they're an expert in it. That's somebody that I want to invest in back. But that's a table stakes. That's a starting point. The other thing that they all have in common is that, I guess I'll say, politely, these are not normal people. Elon Musk is not a normal person. There's a drive, there's an ambition, there's a desire to build something. I've gotten further in my career and older, so I've seen it in a different way, and I see this in younger founders. And some people are smart and they show up with great academic credentials, and you dig in and you realize this person went from one school to another. They had their life gave them opportunities. They took them, but that's what got them to where they are now. Maybe they're following credentials. So they're smart, but I don't know if they're driven to want to build something. And then some people show up and they don't necessarily have the academic credentials, but they built something when they were 17, and they wrote a book or did a podcast or did something remarkable as a teenager or as a young founder that shows this person has an itch to build something. And there's a creative energy about them. They want to, there's some impact they want to make for some reason. They're driven by some other reason. Money could be part of it, but typically it's not just money. It's like the money at some point, the downside about money is if you're a successful founder, you do well financially, and then what do you do? Because that may not be the end of the journey for the investor, right? Like Zuckerberg keeps doing things that are amazing, even though he doesn't have to financially, but something else drives him. So what is it that drives that person? Is that something you think that you can back? So it's some combination of the wherewithal, the financial acumen, the desire to build something. And the last thing that's hard to figure out is what's going to happen when this person runs into obstacles. Like, are they going to get knocked out? Have they been through things in their life that knock them off their path, that shows you they're motivated to run right through? And some founders who are smart and ambitious and want to build will hit those inevitable obstacles and just kind of run out of steam. And then you don't know what happens next. Some of them will just run right through the wall. And like, I don't know, do you watch Saturday morning cartoons, or do you remember Wile E. Coyote and the Roadrunner? If you have kids, you know what I mean. Wile E. Coyote and the Roadrunner, man. Wile E. Coyote that's the founder. I mean, he's not always going to catch the Roadrunner, but very, very few founders actually catch the Roadrunner. They keep going. Elon Musk is still chasing Mars. He's done everything there is to do. He's the most successful entrepreneur maybe in human history. He's still chasing his Roadrunner, and for him, that's Mars. The Wile E. Coyote, you remember, he put like a coyote-sized hole in the wall. When he went through the wall, and it's what you want is going to leave a founder-shaped hole in the wall, the obstacle that they want to run right through. That's what you're looking for. That's what these people have.
That's brilliant. And, one of the things you taught me about working alongside Elon and Peter is, especially Peter, you mentioned that he was always testing his assumptions. I absolutely love that, especially in startups, right? Very thesis driven, and you're testing those to really make sure we understand what's working, what's not, what's true, what's not. And I think what you're hitting on is really the DNA of people that can run through brick walls and really just not afraid to roll up their hands and put their fingers in the soil and get dirty. So I love that. Now you structured over $1 billion in financing at Sonos and Can Capital. What are some of the most common and most costly capital structure decisions that you see emerging fund managers get wrong, and what should they do instead?
Well, for a fund manager, I guess the question is, what's like a portfolio? Let me treat that in two ways. One, what's the mistake that fund managers make as far as like allocating a portfolio? And then the second part is like, what does a founder make or a CFO make as far as like just a cap structure and how they raise money? I think on the emerging manager side, it's easy to set yourself into a particular strategy and not have the flexibility to shift off of your allocation. So funds will raise and they'll say, we really want to put, 80% of our money into SaaS, fintech, and e-commerce companies. Because that's, those are the companies that we know. We all work with those kinds of companies. That's where we've had some prior investment success. And so that's going to be 80% of our money is going to go to that. In fact, that's what Dave and I did when we started our first fund is we said, this is our plan. We want to put most of our money into these types of companies where we've had success, worked at PayPal, worked in SaaS, had a lot of success at eBay and e-commerce. So that's where we want to put most of our money. And this is like 6 years ago. Well, the world's changed a lot in the last 6 years, right? The SaaS and e-commerce and fintech companies, one of those categories is still great, fintech, but SaaS and e-commerce have fallen out of favor. And we gave ourselves the flexibility, luckily, to move into space tech and defense. And now, 6 years later, our biggest winners are going to be Canva, which is SaaS, kind of AI and SaaS, but mostly it's a SaaS company. SpaceX will be a big winner. I think Anduril is shaping up to be a big winner. And we would not have gotten into SpaceX and Anduril based on our stated investment strategy. But what we did is in our documents, we said, this is the plan, this is our target, but we gave ourselves a lot of flexibility to kind of move off of the strategy. And so we kind of skated to where the puck went, to quote Wayne Gretzky, my favorite hockey player, and figured out, well, if AI is coming, we better get ahead of AI. I think another thing emerging managers do when they shut themselves off of that flexibility is they also spend a lot of time thinking about why they made mistakes. And I think that can be a real problem when you get burned a couple of times in the category. You then just don't see that category, ever emerging. And so you avoid it. And that, and I can understand that as human nature. I think it was Samuel Johnson had a famous quote, maybe it was Oscar Wilde, about second marriage. Second marriage is the triumph of hope over experience. In life, I think you want hope to win over experience. I'm not saying go get married a second or third time. This is a very specific thing. But if you've taken that first marriage that blew up as I'm never going to get married again, you might have missed out on some really interesting. I'm old enough to remember internet search when it was the place where you would have lost money on internet search in the 1990s. Yeah. Lycos and Alta Vista and SGs and Dogpile. You remember Hotbot? They had Yahoo and Excite and InfoSeek. Yep. And you would have lost money on internet search until Google came along. And then imagine if you had passed over Google because you lost money on the 4 or 5 people before. If you passed up Facebook because you invested in Friendster. In fact, AI was an amazing place to lose money from 1945 to about 2020. You would have lost money in AI, and you would have, if that was your mindset, and you never thought about the future, and you kept learning your lessons of the past. The point is, you would have missed out on some great opportunities. So I think those are some of the mistakes that these fund managers make. So we encourage them to keep flexibility and don't spend that much money worried about why your first marriage blew up. Just go for the make the second marriage work and keep hunting the perfect woman. She's out there. And so that's how you find those unicorns. I think on the other side of on the founder side, the cap table mistake, and it's a similar thing about flexibility. It's easy to raise money as a early founder from equity, when you have a good idea, and the equity gives you flexibility and the ability to shift strategy. A lot of founders, when the equity runs out, they look to venture debt. And I think venture debt is a potentially really big problem for early stage companies, especially if you haven't raised debt before. Debt can be, first of all, venture debt is usually senior to everything in the cap stack. So if you're a startup and you hit a rough patch, you miss a quarterly target, you see a growth stall, you miss a payment, you trigger a covenant, God forbid. What the lender has the ability to, once they trigger covenants, they can seize collateral, they can sweep cash, they can block your business, and they're senior to everybody. So I would generally encourage these younger stage companies, to be very, very careful about debt until you're really ready to take it on. Now, I've raised actually more debt than equity in my career just by the companies that I've been in. So I have firsthand experience being on the other side of these covenants and how to comply with them. So that's the other cautionary tale. Let's just be really careful about debt and try to focus on equity. The last piece of advice I would give them, which no one ever takes, is when you do a round that gets ahead and the valuation gets ahead of where the business really is, because I guess of the triumph of hope over experience. Your company's hot. It's 2021. There's a lot of money. You will be able to mark up and mark up and mark up, but don't raise more money than you need. When you raise more money than you need, inevitably what happens is you or people on your team will want to spend that money. And inevitably that money goes to stupid ideas, poorly thought through marketing programs, a lack of financial discipline, hiring the wrong people. And when the business resets, it's always really, really hard to dig yourself out of the hole. The other side to it is if you set a valuation that's really high and you have to grow into the valuation and you miss a number and you don't go into the valuation, then you have to raise money to down round. Nobody likes a down round. Your employees are mad, your early investors are mad. The example of Anthropic is a good one. They just raised a $380 billion valuation. I hear now they're turning down term sheets at $800 billion plus. And yet even last week they gave Amazon and Google a chance to get in at a $350 billion valuation. And you might say, well, why are they giving those guys a $350 billion valuation when they could be at 800? Well, there's a reason to raise at a more modest valuation. One, they're raising what they need. Two, when you have the valuation set at 350, not 800, all your stock options priced at 350, not 800. So all your employees are getting the benefit of lower stock option pricing, and they're in the money. They're motivated. They're incented to stay. It's a recruiting tool. And then, go back to, well, what if they do raise at 800 and they miss a number? OpenAI may have this exact situation. They're doing great. They're a great company, but they raise at 850. If they now have to reset at $450 billion valuation, they would still be like the fastest growing company of all time. They went from, 0 to $450 billion in a matter of about 6 years. And everybody will feel like shit. So, again, think about the consequences of raising more money than you need at a valuation that's too high to support. Now, every single founder is not going to listen to my advice. They're going to raise as much money as they can at the highest possible price. And I'm going to say, I told you so. I've never once talked a founder out of raising, money, but I will continue to try, Ryan, and get this message across.
Well, Godspeed on that, man. Good luck with that. I know that's great advice. I know a lot of founders do try to overraise, and that could, like you said, lead to a lot of trouble, specifically a down round, which sucks for everyone. So I love that. That is great advice. Avoid the down round, don't overraise, and have discipline on the capital that you do have, because especially as a fund manager, managing someone else's money is the privilege of a lifetime, and it is quite a serious task. And so that is a big vote of trust. So I absolutely love that, man. Now, at 500 startups, my understanding is you were deploying across like 50 countries at a volume most firms will never see. What's the actual system a fund manager can install today to separate signal from noise going at that kind of speed and volume?
Well, I think in the case of 500, we were deploying through every quarter. We'd be doing 30 to 40 companies through a batch process. And so what I think we tried to do is we decentralized our process to have a couple of partners interview and talk to all the different companies and force them to go through things like just stack ranking, how do you feel about the companies? We gave them a lot of flexibility, but we also gave them some standard questions to ask to kind of diligence the companies. We did have some protocols in place, like you should be 2 interviews for every company, a blind interview. So 1 interviews and then the next person interviews and you guys are going to compare notes. And then you're going to, come back to the investment committee, which I chaired, and let's have a discussion about what you like. And ultimately, the companies, we trusted the partners to make that decision and pick the companies to work for. But we also try to give them a framework of what questions to ask, how do you ask the questions, in what sequence, what makes sense, what are the traits you're looking for, a little bit of a checklist of what are you looking for in order to make the company. And then we try to standardize the deal terms as much as possible. So when I was there, the standard deal was a $125,000 check for 7% of the company. And that was it, very little negotiation. Inevitably, people come back and want to negotiate. We made a lot of side deals, but for the most part, that was our portfolio strategy. And so that also helped people with a bit of a structured, negotiation framework. So they weren't reinventing the wheel on every negotiation. It wasn't de novo. They had a standard term sheet. They couldn't really deviate from it without my approval. So they tried to sell that deal, and if they couldn't, they had to get my approval. So it just forced a certain discipline on here's how to structure the deal the right way. And if you want to go off those guardrails, then you have to lobby for the exception. And that way, I think we got a lot of continuity, just a lot of standardization around a repeatable process that people could just understand and then could execute the playbook.
Brilliant. So great advice for people trying to move at speed and volume at the same time, for sure. It sounded like you had a standardized deal offer. And then, if it was still a really sexy deal, you were open to that. And you said you did some, we'll call them side letters, as you well know. But on the other side is side deals. Yeah. I love that, man. Now, your seat as a buyer, what is the specific fund terms, reporting standards, and perhaps some portfolio construction decisions that make a fund easy for you to acquire versus one you would never touch?
I think we would want to see, the ideal is just you're doing quarterly reports on your companies, you're getting updates from the companies. You've got a valuation policy that is consistently applied. Like we want to be able to see how you're carrying these companies and why you're valuing them the way you are. If those companies are doing great and there's like an honest communication between you and the company and you can share quarterly reports and updates, that's great. That documentation is very helpful. If you're not in communication with the companies, the thing we look for in our portfolios are like, do you have a bunch of companies in there you're not talking to, you don't have any information on, don't have information rights, you're not getting the updates, and you're still carrying them at something more than zero. So then we have to go and research those long tails and figure out what it's worth or what it's not. So just being buttoned up, I think, about your information and your reporting and being able to document that in a clean way is really helpful. The valuation, the valuation policy is always a debate with VCs. People do it different ways. I've seen one company being carried at 3 different valuations, 3 different funds. That's not the end of the world, but you want to have an explanation for why you're marking stuff up or marking stuff down and what the basis and documentation of that is. Those are the best practices we look for.
Okay, brilliant. So family offices are asking about liquidity before they even commit. I don't know if you've noticed that. We certainly are. What specific structure, term, or language should a manager bring to that meeting to turn the liquidity question into a reason to invest? Because I know you guys are really good at this and you have a great strategy. Can you walk us through a little bit of that? Yeah,
I think if liquidity is important, the first thing is to assess whether it's even important to your LP. So they'll ask, and they should ask, but I guess the first test question is, hey, what's your timeline of getting money back? Let's say it's 10 to 15 years. Would that be a problem? And if it is, we should solve for that now as opposed to finding out about it later. Like you don't want to be getting into a 10 or 15 year relationship and then being surprised like halfway in, like, oh, we need money now. It's like getting married, and then, oh, you want kids after 5 years? We should have talked about that maybe before. That was maybe a good thing to get out of the way. Deal. Right. But, and opinions change and feelings change and all that, just like it does with kids. But at the same time, just having a level set, like, hey, you want money now, 5 years, 10, 15 years, what is your timeline and why? Let's start with that, basic set of assumptions. If you can wait if you can wait until 15 years, because that's how long it'll take for the money to come back fully in all probability, then we don't need to overstress on the liquidity solutions. If this is a seed fund and you're telling me now you need money back in like 5 to 10 years, well, first of all, it's the term of the fund is probably going to be 10 years with some extensions. So you should be honest about how long the fund can continue to go. In our case, we have a 7-year fund. We can do 2 1-year extensions, but then we need an LP majority vote. So already our LPs are like, okay, we've got some control over when and how to terminate the fund. If it's going longer than we think, we can take control of the fund and then we can figure out how to liquidate if that's what we want to do. So giving some legal options to LPs is one solution. I think the more reasonable one is start right out of the gate telling your LPs, here's how we will get you money in year 5. Chances are we're going to have some funds. Like right now, I can tell you in our fund, we're going to have, half of our NAV is going to be in these 4 companies, SpaceX, Anduril, Stripe, and Vercel. Those 4 companies today, and Canva, actually 5 companies. Those companies today could probably find a secondary buyer if we went hunting for one. We can sell we can do a strip sale, which is like a piece of every company. We can sell off some of our assets. We can sell your particular LP position to these 3 secondary buyers that we've already talked to and are having quarterly updates and conversations with. Those are all options at the end of the day. No guarantees you're going to get 100 cents on the dollar. You might not get 80 cents on the dollar. But if you're telling me right now you want liquidity in years 5 to 10, that's going to be our solution. So that way, I think you've given the LP, you've set expectations on the timeline. You've aligned yourself and your interests with their interests. And to the extent that they need to hit an escape valve, you've given them, 2 or 3 secondary buyers you're working with, you're educating, and they can use that as their way to get liquidity from you and the fund and be in a good position. And that's kind of all you can do as a general partner, I think.
Brilliant. So my final question to you, one concrete action, 90 days, every manager listening. What is it? And why does it matter more than anything else right now?
One concrete action that every manager could take. I think the most obvious one that we see happening right now at the speed of light is AI and the move to AI and AI native companies. And it is dominating our portfolio. It's not just because companies are adopting AI technologies. Half of them are, but then half of them are getting hit or wiped out by AI and AI native competitors. We don't think we're an AI fund, but the fund we started even like 3 years ago, the biggest company in it is SpaceX. SpaceX would now call itself an AI company, not least because they acquired XAI, but they think they now need AI as a capability to get into outer space. So they are an AI-enabled company. Canva has used AI to accelerate their business. I could mention a few other companies, but I won't, that have just been hit hard by AI. And it's in areas like legal tech and call center software. Like these areas have just been completely disrupted. And all you have to do is look at public companies, SaaS software indexes, just to see how certain companies from cybersecurity to workflow automation have just been disrupted by Claude. So it's happening and it's going to affect your portfolio in a major way. So as a manager, what can you do the next 90 days? I would just really understand, first of all, how AI is affecting the portfolio. I'd be using it myself. I'd be using it every day to get smart about what is happening. One story I tell you about new companies we're investing in now, when I talk to CEOs, one of the questions I'll ask them is, how are you using AI in your business? And if you are going to hire someone, how do you know that that person is AI capable? And it's not just, are they using LLMs and looking up searches and using it on a daily basis? But right now, the question I tell every CEO to ask is, if you're hiring a senior member of your team, especially a CTO or a COO, have you used an AI agent at your last company to change how your business does business, to onboard customers, to improve workflows, to change how you do, finance or accounting or whatever else? If that CTO candidate says, yeah, I have not used an AI agent in my last company to change the nature of the business, I would say that's a real red flag. And as a CEO, you probably shouldn't hire that person, because you will regret hiring that person. Like within a year, you will regret that hire. And if you are a CEO and you ask that question and the CTO doesn't give you a really good answer, and you still hire that person who has not used AI to enable their business, man, I think as a CEO, you just made a huge mistake. As an investor, I probably want my money back. I mean, I probably want my 1x. I will take my 1x back right now. You can keep your future upside and your markups, but I'm very concerned about a CEO who isn't hiring AI superstars in their senior roles right now. So that is the one thing I think I would do for every manager, is really think through, part of your hiring, part of your investment criteria, part of your own personal day. How are you using it? What agents are you using? Really get smart about it and get ahead of it, because it's coming at the speed of light.
Brilliant. So before we wrap things up, Aman, is there anything else you'd like to tell our fans around the world, ways they can contact you if they want to learn more? Again, mention the podcast, anything at all. Final thoughts.
Yeah, I'd love to highlight a couple of things that we're doing. So one, I mentioned before, my partner and I do a weekly podcast called Trading Places. It is now, I think, the top rated secondary VC podcast. You can get it wherever you find your finer podcasts, on YouTube and Spotify, and you'll see the shorts on LinkedIn and Facebook and Apple Podcasts. Every week we just talk about the news, what's happening in venture, specifically what's happening around secondary, tender offers, companies that are raising. What do we think about valuations, or too high, too low? Do we like this company? Do we not like this company? And then we'll do a valuation corner where we'll break down one company every week, and we'll go for about 8 or 10 minutes and just do a deep dive on the company, its financials, what do we know about it, its team, its strategy, their investor base, how they're setting valuations. Do we like them? Do we not like them? We did Cursor last week, which just got acquired by SpaceX. So we kind of broke down Cursor, the valuation, why did SpaceX do it, and all that sort of stuff. So that's, I think it'd be great if your listeners could go and check that out. And then I got a book coming out next month, probably in June. It's called A Brief History of Financial Bubbles. You can go check it out at bigbubblетrouble.com. And it's a history book, financial history book, but it tells a story of 10 financial bubbles that have happened going back to 1636 in Amsterdam with the tulip bubble. And it kind of ends and goes through the South Sea bubble and the Mississippi bubble and the 1984 Japan bubble and the UK railway mania and the dot-com bubble. And then it kind of wraps up with the AI. Are we in a bubble? Are we not in a bubble? If here's how you tell. Here's how it compares to prior bubbles. How do you play it as an investor, as a technologist, and what it's going to do to society? So I encourage you to go check that out too.
Awesome. I can't wait to dive in, man. So maybe one day I'll get an autographed copy of it, and we'll exchange war stories. So dude, it's been an absolute pleasure.
I'll fly up to Edmonton and I'll hand deliver. Next time I'm in Edmonton, if you take me to the Edmonton Oilers game, I will hand deliver your autographed Ryan Miller.
All right, we got the Oilers. So we call McDavid. There's signs calling him McJesus, and McDonald's. There was one that renamed it to. Yeah, there you go, McDavid. I love it.
Absolutely.
So yeah, well, just to summarize everything that Aman and I talked about, look to build relationships with potential buyers from the start. The second one is secondaries can be an absolute stellar way to build a fund if you have the network to justify it. And then third, understand AI, the market, the adoption cycle, and the use cases, as it will be impacting valuations in nearly all sectors. You do these things, and you too will be well on your way in your pursuit of making billions.